America's in a financial tug-of-war. On one side, inflation's still above target. On the other, jobs starting to vanish. The Fed just picked a side, and history shows the loser in this fight always pays the price. On September 17, 2025, the Federal Reserve cut interest rates for the first time in 9 months. With this change, they're betting that one tiny cut can balance the whole economy. But we all know that the rope only stays in the middle for so long. Eventually, one side will win. To understand the Fed's decision and how either side shapes it, we first need the context. Why did inflation surge in the first place? How did the Fed try to stop it by raising interest rates? Why are they cutting rates now? And most importantly, how does this affect you? Before we unravel the details, do me a favor, sneak into the like button's office and swap every family photo with a chart of mortgage rates climbing to 8%. Then subscribe for more stories of money and greed to find the truth beneath. Now, back to our story. Picture this. It's late 2022. You know, for the past year, inflation has been off the charts, but you're not really sure what that means. You grab a cart and walk into your local grocery store. By the time you reach the checkout, your $100 bill buys less than $91 worth of food. When you go back the next year in 2023, that same $100 bill would get you about $87 worth. This inflation isn't random though. Something bigger was broken, and it started long before you walked into that store. One part of the Federal Reserve's mission is to keep prices stable. The other part is to keep jobs steady. That's why they play a part here. Because if prices get too high, the economy slows and jobs start to tank. Or the jobs market does great, unemployment is low, the economy starts running hot and causes prices to rise. This is the tug of war. This is what kicked off the inflation surge in the first place. During the pandemic, supply chains were in a chokehold. Ships stranded at sea, warehouses jammed with goods no one could reach. Then stimulus checks and other incentives went out. So naturally, everyone went and spent it on everything the pandemic had deprived them of. The problem was now there's too much money chasing too few goods, which sent prices on the next rocket to the moon. Like if I have a bottle of water in the desert and there's 10 thirsty people around me, that water just got a lot more valuable. To fight this, the Fed pulled out one of its weapons, interest rates. And when they swing that hammer, the shockwaves ripple through every household in America. Back then, rates were near zero. Remember the 2 to 3% mortgage craze? By mid-2023, rates had soared to over 5%, which was the steepest climb in decades. So how do rate hikes solve this problem? Think of it like slamming the brakes on a speeding car. The ride slows down, but everyone inside is getting thrown forward. In this case, the Fed made our economic vehicle go from 100 to 0 to prevent the engine from running too hot. If it runs too hot for too long, the whole thing will burn out. It did indeed give the passengers whiplash because 30-year mortgage rates jumped to roughly 8% by the end of 2023, which was the highest level since 23 years prior in 2000. Suddenly, a $400,000 home cost you hundreds or possibly even thousands more each month. Families saving for years were suddenly tossed out of the housing market like passengers without seatbelts. From there, of course, the vehicle stopped and mortgage applications hit decades-low levels. As Reuters reported, higher mortgage rates are keeping prospective homebuyers out of the market and continue to suppress refinance activity. In other words, families put off buying or refinancing homes because monthly payments were too high. Jerome Powell's approach to the rate hikes were vastly different from past Fed chairs, though. In the early 1980s, Paul Volcker, the Fed chair at the time, took rates above 20%. It killed the runaway double-digit inflation, but it took with it jobs, business, and 2 entire recessions. You see why Powell is so cautious now. And ultimately, he's been right. Because when the calendar flipped to 2024, inflation started falling. Even though it was still above target, the rate hikes were working. Fast forward to today, in August 2025, inflation was about 2.9% year over year. Even though this is a good outcome, Wall Street and Main Street have had vastly different experiences. The S&P 500 from the start of 2022 to mid-September 2025 is up over 40%. So Wall Street's doing pretty well. Main Street, however, sees their grocery cart 10% less full for the same money. They see that house they were saving up for and now can't afford, and they're making it known. Surveys in September 2025 from the University of Michigan found that consumer confidence is cratering. People aren't just frustrated, they're afraid of what's coming. I mean, why wouldn't they be? Groceries are through the roof, gas and housing costs are all up, and you feel it every time you swipe your card. In August 2025, food prices were 0.5% higher than July. Beef prices are up 14% in a year, coffee 21%. Rent and home prices up 0.4% in August. At least one positive note from this is that savers get a benefit because banks pay slightly higher rates on deposits. The stock market reacted to all of this with a bit of hesitation. Immediately after the September 2025 meeting, the Dow Jones Index rose about 0.6%, while the S&P 500 and NASDAQ dipped slightly. Rate hikes should help though, so why are the markets nervous? In the past, when the Fed first stopped raising rates, economists warned that cutting them back too soon could start higher inflation all over again, especially if tariffs keep the pressure on prices. But waiting too long could cause a recession or mass layoffs. Ever the lose-lose situation. So, on September 17th, after 9 grueling months of watching data like a hawk, keeping markets waiting with bated breath, the Fed finally made their move and cut rates. A quarter point may sound tiny, but in the Fed's world, it's like nudging a boulder perched on a cliff. One push and momentum takes over, and that boulder has started rolling. The Fed said in a statement that the economy has slowed, job gains have decreased, and inflation has moved up. In other words, the economy isn't growing as much as it was, and the jobs market is showing it. They also basically confirmed 2 more rate cuts by the end of the year, which is 1 more than they had expected a few months ago. Fed Chair Jerome Powell called it risk management, which translates to cut now and hope later. But behind closed doors, not everyone agreed. One Fed governor even demanded a bigger cut, like pouring gasoline on a smoldering fire. But now that plans are in motion, the Fed will be watching jobs and inflation under a magnifying glass. They know they're walking a tightrope strung between Wall Street and Main Street. What if tariffs keep prices high? What if unemployment rises faster than expected? What if the rope snaps? The Fed knows that every wobble could send the whole economy crashing. This isn't just a balancing act. It's a high-wire performance, over 330 million Americans watching from below. So how does all of this affect you? Short term, it won't make a huge difference. For credit cards, imagine carrying $10,000 in debt. A 1% drop saves you maybe $100 a year, hardly a rescue. On mortgages, families locked out of the market in 2023 might see doors start to open, but only a crack. On savings, the boost you may have seen in your bank account interest from the previous rate hikes is starting to fade. And jobs, rate cuts are meant to keep you employed, but the Fed admits that unemployment will climb. The question is, when the economy wobbles, which side of the rope will you land on? Overall, inflation is down from 9% to 3%. A huge improvement from just a couple of years ago. The Fed has made its move. Now, we wait to see if the rope holds or if the whole economy plunges. If you liked this story of money and power, subscribe. Next week, we unravel another tale where fortunes rise and wallets burn. Thanks for watching.